Okay, so hi everybody. My name is Shafi and I'm the co-founder of Coverager. And with me today, I have John Swigart, co-founder and CEO of Pi Insurance. I have no doubt that you guys don't know who he is because it seems to me that everybody in the crowd is a Coverager reader of some sort. But we're lucky to have him today. I reached out to him after their Series B round. And it was mostly because, and kind of expected in a sense, they're going to be assuming some of the risk, right? So there was an interesting funding announcement where 100M will be allocated to either acquiring or starting insurance companies. And I've had a few questions of my own that I wanted to go that are below the PR that we tend to see out there. So there is a Q&A chat bot. You're more than welcome to use it. I'll start with questions. And John, thank you so much for joining us.
Thank you, Shafi. Thrilled to be here.
So first question, when I read an article in which you said that the distribution in insurance isn't broken, that really the opportunity is on the insurance company side, and this was in light of the recent funding and your new strategic view, can you share of just the current events of where Pi is at following recent funding, and what does that mean to the company going forward? And obviously, how come distribution isn't broken? I think it is, but go ahead.
Yeah, happy to. So my background before founding Pi is I was in personal auto insurance. I was at Esurance for 13 years from 2000 to 2013. So my experience with distribution insurance spans a lot of direct distribution, and now at Pi, we sell sort of multi-channel. We sell directly to small businesses. We sell through independent agents. We use channel partners as well. And that was part of our strategy from the very beginning. In personal lines, you have direct distribution, you have captive agents, you have independent agents. You do have a broad suite of distribution options. In commercial lines, it's much more heavily focused on independent agents, certainly, and direct is emerging. And I think direct will grow substantially over the next decades, frankly, and potentially even grow faster than it grew on the personal line side. But it is very, very, very small today. The reason I say that I don't think distribution is the broken side is distribution is more about customer preference. And by customers, I mean the actual buyers of the insurance. So even in today's world of 2020, you still have a meaningful chunk of personal auto insurance that's sold through independent agents because there are customers who prefer that path. What you don't have in commercial lines is as much of a breadth, and so everybody's buying through independent agents. And independent agents, I think, are a key element in the commercial lines space. It's a slightly more complex set of products, and certainly the products that you need and what the coverages are that are offered. And I think the independent agent can provide a lot of value in the commercial line space, and frankly in the personal line space as well, if that's what the customer wants. What is the bigger difference, actually, that as we really looked into it, is the players in commercial lines, being the carriers themselves, are operating frankly, massively differently than sort of the personal lines carriers or the personal lines arms of the carriers that do both. So classic examples of this are average expense ratios. So average expense ratios in commercial lines are, when you aggregate everything together, including LAE, are pushing 40%. Average expense ratios in personal lines are more high 20s, around 29, 30%, and you have players like Geico in particular and USAA that operate these sort of low 20s in total expense ratio. And so fundamentally, when you have customers paying premium and a lot of it's going to expenses versus returning to them in claims, you have a less efficient process and less value being derived by the customers. And so I think that's one of the broken elements in commercial insurance and the incumbent carriers is their inability to operate efficiently such that they're returning more and more value to customers. Pricing structures are another area that I think is more broken broadly. Listen, there are very sophisticated pricers in commercial lines, but it is a much more fragmented market, and it is not significantly sophisticated along the lines of personal auto insurance, for example, or homeowners insurance, where there's very data-driven, highly sophisticated algorithms identifying risk across the whole spectrum. That is not as evident in commercial lines. And a simple example of this is, in my view, many commercial lines carriers are looking for the right customer to fit their price rather than looking for the right price for the customer. And so you have, whether it's in workers' compensation, sort of underwriting appetite. One of the big value propositions that Pi brings to the table is we have a broad underwriting appetite. Most private carriers in workers' comp will only underwrite around 50% or less than 50% of the classes. It's not all the same 50%. Obviously, you have different folks serving different markets. But that's just not the case in sort of the best personal lines companies. They're writing 90+% of all folks out there. And I think the similar opportunity exists in commercial lines.
So 2 follow-up questions. You talk a lot about appetite and you talk a lot about the right customer. So who's your sweet spot in terms of who are you reaching, Pi Insurance currently, if you can describe that market for us? And in terms of the appetite, I understand there have been some changes because of COVID or because of the pandemic. And can you touch a little bit about that?
Yeah. So we write a broad spectrum. We write over 80% of all classes. It doesn't mean we write every business within each class, but we write a very broad spectrum of classes. There are, depending on the bureau, 550 to 600 plus classes in workers' compensation. We, as a sweet spot, we serve more so, not because of any strong preference of ours, but more that's a strong preference of the customers today, in what I call kind of the blue and gray collar lines. So I would say 80% of our customers are classic sort of hourly wage businesses. That's contractors, specialty trades, janitors, truckers, landscapers, restaurants, retail. We do write our share of offices and accountants and stuff like that. But frankly, we tend to write more sort of the middle ranges. And we write all the way up to roofers. We will write roofers under certain circumstances and so forth. We write a broad range of contractors and construction as well, and those specialty trades. So that's the bulk of what we see coming through and what we end up writing, but we do write across the full spectrum. On the COVID question, we actually do write a fair bit of home healthcare and healthcare related stuff. We did pause the home healthcare new business sort of in the beginning of March when we started seeing things emerge there. We've done a tremendous amount to try to work with our customers. Small businesses are at the nexus or the sort of the core pain point in this crisis. With they're struggling. If you're shut down for a long time, most small businesses just do not have the cash reserves to be able to handle that. And so we've reached out proactively to our customers and encouraged them to be in touch with us if they've had to lay off workers or reduce payrolls in any way. We want to make those changes midterm so that we can reduce the amount of premium that they need to pay right away to give them some of that immediate relief. And we've had great success and great feedback from our customers to that proactive approach we've been taking. So we've reduced eligibility only very slightly in that one class. Otherwise, we're open for business.
Interesting. So in terms of endorsements, is that something that you guys do digitally? You handle that within Pi Insurance?
In terms of the request for the endorsement?
Yes.
Yeah, well, the endorsement, we need to have a conversation with the customer in order to understand sort of where they are and prefer to do that on the phone with them right now. But we're reaching out to them, obviously, via email and other means as well. So
sounds good. So in terms of marketing tactics, right now this audience is being challenged, right? It may be hard to reach for a sale, right? More for a service element. Have you factored that in terms of how you're going to market going forward? And this is for the sake of the audience, guys. I think Pi Insurance in 2019 launched a series of TV ads, right? Are you planning to continue in that path?
Yeah, so we have a range of marketing approaches and campaigns on the direct side. We did see a declining response to the advertising, not just the television advertising, but digital advertising as well, as COVID really started to emerge in March. And we pulled back on that in response to sort of that declining response rate. So we're doing less direct marketing now. We think we saw the bottom of the trough in late April, May, and we're starting to sort of spool things back up. So you'll see our television ads again modestly in the summer. What we are seeing more of, and I actually saw not much of a decline, was on the agency side. So the interesting thing about agents, independent agents, are small businesses too, and they are fighting for their lives. Their customers are fighting for their lives. They themselves are sort of working hard to make sure that they support their customers, that their business is viable. They've had to go to work from home. We did see a decline in our submissions through the agency channel. That definitely bottomed and is climbing back up, and we're now back up to the levels that we were seeing in the first quarter of 2020. So the agents, frankly, are working very hard to try to save their customers money, to try to get them into policies that are going to save them money, that reflect new realities of their business and so forth. And they've just been tremendous partners in this crisis. And we do think, and we hear anecdotally, that all of our systems are cloud-based, right? So agents that have struggled to go and work from home because of various agency management platforms or other things that really only operate within their office, we're seeing increased submissions to Pi because they can do that basically just through an internet connection and do all the work that they do with us. So, and we've been work from home since the middle of March, but all of our folks are 100% work from home capable the day they start with Pi. So we haven't been able to, we haven't missed a step, and I think that supported us on the agency side.
So I will share an anecdote, because I think that, if there is an opportunity for renewal or for just pricing coverage again, or just checking out quotes, which is what some are doing in order to get a better deal for these customers. So I was telling John before we started this broadcast that I really had this on my to-do list to reach out to him a while back ago, because when we were covering Hourly, which is a distribution partners of theirs, and what they do is basically payroll software providers for hourly workers, and as John mentioned, that's their sweet spot as well. I was kind of poking him to understand who else is hourly working with in terms of work comp insurance companies. And he said he's not going to name all of them, but he said there's a mix of 6, Berkshire Hathaway included, AmTrust included, and obviously Pi Insurance included. But 9 out of 10 times, Pi Insurance wins the business. And of course, I asked why, and it was very simple. He said it's pricing and technology, right? And I think that's probably what is attracting agents to Pi Insurance, right? Because at the end of the day, when people talk a lot about customer preferences, and you can't ignore the fact that customers want to pay a competitive price, even though I don't think small business is a commodity business. I don't know if you agree with me on that or not. I think it's just fragmented business and really hard to move to apples to apples. So in terms of distribution, I'm curious, do you feel like the businesses that you're getting through the agency channel is different than the businesses that you're getting through direct, or the business that you're getting through maybe a TV ad, if you get to that measure of tracking?
There are differences. We see larger businesses, higher payroll amounts, and therefore higher premiums on the agency side than we see on the direct side. So we are different than many insurtechs. We actually have pretty meaningful average premiums. So our average premium across the entire company is about $8,000 a year per customer, and so that's a meaningful expense for a small business. And so their incentive to shop and to sort of look around is pretty significant. If a small business that can save a few $1,000s a year, that's a meaningful chunk of money. Especially our average number of employees in our businesses are right around 10. So it's these aren't significantly sized businesses. These are your classic use the term mom and pop. I'm not a huge fan of that term, but it's classic sort of core small businesses that form the primary sort of backbone of most local economies and so forth. So we see that difference. We don't see a tremendous difference, Sheffy, between like classes that show up versus, direct versus agents. It's just they're slightly more mature businesses, a little bit larger businesses that are coming through the agency channel, which is frankly not that surprising because they're the ones that sort of have some insurance already because of commercial lines and the nature of distribution of commercial lines. They're likely to be with an agent already, where on the direct side, we do see more I'm starting my business up for the first time population. We see more of that in the direct channel than we do in the agency channel.
So I have a question. Who are your insurance carrier partners currently?
So we have one. And they are an investor in Pi as well. So we sell all of our policies on Sirius America Insurance. They have all the licenses. They're an investor in Pi. They support us. We're somewhat unique in that our insurance partner also takes all the risk. So we have XOL treaties, which are an important part of a workers' comp program because workers' comp policies are uncapped. So we have excess of loss treaties that sit on top of that. But other than that, Sirius takes all the risk today. We've designed the rating and the underwriting and all the programs. So we do all of the program management for that whole thing. But they provide the licenses and the ratings and and our sole risk taker, other than the XOL.
And your plans with Pi Holdings?
Yeah, so Pi Carrier Holdings is something that we've had in our roadmap conception from the beginning, and Sirius was involved in incubating this business as well. So this is something that they've been on board with from the beginning. We think it's important for us to control the policy issuing companies that we use from sort of maximizing the opportunity and having that full sort of umbrella around the customer experience to have that single place for that. And so what Pi Carrier Holdings is going to do is own the insurance companies, which we will form de novo, as well as purchase shells and then capitalize them, that will eventually issue all of the policies that Pi sells. We'll heavily use reinsurance on the back. Sirius will be an important partner in that mix. I don't think we'll retain more than 30% of our own risk, and it will potentially be less than that. But retaining some of our own risk is an important piece in maximizing the economics that you get from reinsurers. The way the reinsurance market works is they are much more likely to sort of give you the benefit of the doubt on what you say your underwriting results are going to be if they feel like you are taking a meaningful chunk of that, and you avoid all the fronting fees and inefficiencies that come with if you're not taking any of your own risk.
Another question from the crowd. How do you find high premium paying customers? Isn't that the $1 million question? Especially among insurtechs.
How do we find them? It's about breadth of underwriting and appetite and having quality processes. So basically, we have kind of an appetite approach that we use with our agents that tells them, again, it's broad, but these are the areas where most likely you are to find opportunities for your customers. And frankly, workers' compensation is not a very cheap coverage, right? I mean, honestly, it's on average across the entire class base, it's 1.6% of payroll. That includes accountants and general office workers like many of us in the insurtech space that are paying basis points. We might be paying 50 basis points or less for our workers' compensation coverage on a percentage of payroll. When you get into specialty trades, you're in the 2, 3, 4, 5% range. When you're into contractors, you're in 7, 8, 9, 10, 15, 20% range of payroll. So it's an expensive coverage. We think it's a great beachhead product because it's required. So the small business that has employees has to buy this coverage. They don't have to buy cyber insurance. They don't have to, if they have autos, they have to buy commercial auto insurance, but most businesses don't have vehicles. So it's a broad required coverage that has enough unit economics to build a business around. So I think one of the ways we find that is we find those higher premium customers is we're just in a market that has higher premiums.
What are your thoughts on payroll and benefits platforms such as Gusto and JustWorks in terms of workers' comp? Do you currently partner with such platforms?
So payroll platforms are phenomenal partners for workers' compensation companies because payroll is the exposure base for workers' compensation. There is already,
isn't the market saturated in that regard? There's a lot of partnerships already in that space.
Yeah, so the 800-pound gorillas in that space are ADP and Paychex, which are pushing hundreds of millions of dollars of workers' comp premium. Even so, their penetrations into their customer bases are not terribly high. It's less than 50%, it's 25 to 35%, depending on which one you're talking about, and the penetrations they're getting. They're growing them, but there's still opportunity within them. They tend to work with not many companies. We do have conversations with payroll companies. We will work closely with payroll companies, both in their own agencies to the extent they have them, or if they don't have them, we could work with them directly. Our vision is to be able to offer a solution for payroll businesses that is essentially a few clicks add-on of workers' compensation because they have almost all the data that we need already resident within their systems to be able to underwrite using our algorithms. So I would say stay tuned. That's an area that's going to be coming pretty aggressively. That's great partnerships, and frankly, I think the partnership can work both ways. So historically, payroll has been used as a distribution point for workers' compensation insurance. I think some of those payroll companies are finding that you can switch it and use workers' compensation insurance as a distribution mechanism for payroll, and we certainly see that. Frankly, when you think about what people pay for different things, they pay a lot more on average for their workers' compensation insurance than they do for their payroll service. And so there's some potential to switch that as well.
So question to you about, I think with payroll services, would you agree that a lot of times they want a few options to compare, or is that not a must-have from the end user's perspective?
It totally depends on the customer and what they ask for, right? So, in many cases, usually what we hear from customers is what they get, whether it's from their payroll company or their agent who's helping them, is they say, this is the company that I found for you. It's the best one. They're willing to offer you coverage. It's the best price. And do you want this one? And I can tell you just from our own anecdotal experience of Pi having different insurance coverages, we're not getting like a spreadsheet of these are the options, pick one. It's okay. This is the one that we're sort of picking for you.
I do feel like small business is a game of curation more than anything, which is, a quick one, yes or no, but do you see Pi Insurance participating on SEMC-like platforms where you're being spreadsheeted? So I know these are agency-facing platforms, whether it's Attune or SEMC or both Penguin. What do you think about these companies? And obviously, everybody's different, so you don't have to comment about specifically each one. But
yeah, I won't comment on any specific ones. But our goal is for Pi to be available wherever small businesses are shopping or may be inclined to shop for workers' compensation insurance. So my broad answer would be yes. Okay. In order to be in those environments where you're being spreadsheeted, which I have a lot of experience of that in auto insurance, you have to be very confident in your ability to price the risk because that's where it gets exposed if you are mispriced. And it's risky both ways. If you're mispriced on the high end, well, you don't sell anything, but you haven't taken any risk. And if you're mispriced on the low end, you're going to find out. So you have to be confident in your ability, and that's fundamentally what we think we're best at. So yes, we will and would be happy to participate.
So that's a call to action to some of the attendees. Here's an interesting question. Best way to onboard mortgage brokers on an InsurTech platform? Mortgage brokers.
That is an interesting question. I don't know specifically about mortgage brokers because I haven't worked directly with them, but I would say the best way to onboard distribution partners is start small and get a group and build champions within the broader build a group of champions within the distribution partner who can then be your sort of evangelists and your spreaders, whether you want to call it train the trainer or a group of champions or whatever. But where I have seen these things fall apart is where you don't actually invest in getting those early wins that people can demonstrate and share. Oh, this actually does work. Because people are really only going to have an attention span and a willingness to try something once or twice. And if they weren't properly trained or they don't see examples of success, they're going to try it once or twice. It's not going to work out for them, and they're never going to try and sell it again. So that would be my generic advice on that. I don't actually have direct experience on the mortgage side.
Who picked up the name Pi Insurance?
So Pi was a name that was developed. We actually had a marketing consultant early on, a woman that I've worked with a lot, and took us through a naming exercise. And I will say more broadly, I spent a lot of time in marketing. Naming is my least favorite activity because everybody has an opinion, and it's very hard to choose a name for a new business, and harder all the time because there are sort of no names available left. It resonated with us because we picked it from the standpoint of pi, which is the mathematical, constant in geometry, and to sort of symbolize analytics and sophistication around that, and the notion of making things easy as pi as an idiom. And so it was that combination, which is why you get the logo with the elevated E and sort of separated and so forth. And then we wanted something different, frankly. We wanted something that kind of left you feeling a little bit warmer and friendlier than traditional insurance approaches. And I could buy the URL. So that's kind of the final.
That's important.
The final decision, yeah.
So when did Pioneer, this is how you call your employees, so we'll talk a little bit about culture and the makeup of your company. When did that begin?
Early on, we love Pi puns, right? So,
okay.
To the extent, and we have some of our team that really invest heavily in that. So Pioneer is a way to describe our team members. I personally don't like the word employee. I think that sounds like a very transactional relationship. I like team member. That's why I like Pioneer, because you're more of a member of the organization that's building the value. And we have other examples. So my co-founder Dax and I, we give Pireside chats. And, there's a ring of Pyre outside our sales organization where it depends how they choose to do it. You either, if you're the winner, you get to go in the ring of Pyre, or if you didn't actually make the goal, you have to go in and read some poem or something like that. So we love Pi puns.
So side story, but I work with my brothers, and you get a chance to see how they feel about you when you work with them outside of the family, of course. Mm-hmm. But my brother was describing me to someone else. I think it was someone from the Zebra. They were talking, and he basically said, with Sheffi, it's all work. So I told you, when I read Pioneer, I smiled. And I think when I look at InsurTech versus insurance, I know there are blurred lines, but hopefully with InsurTech, there is more focus on culture, which oftentimes sounds fluff, but sometimes you do see a company that actually say it and mean it, and it shows in Glassdoor reviews. I have another question from the audience. How do you, oh, okay, actually I have a lot. How do you balance the desire to grow fast and just in the slow pace insurance industry, specifically customers that aren't excited to think about insurance? Well, you kind of answered that in a sense that work comp is mandatory. So
Yeah.
you're right, you don't have to convince them in work comp, but yeah, go ahead.
Yeah, no, I think, listen, our view is that there hasn't been a tremendous amount of innovation attached to more broadly than insurance, sort of the required services that small businesses have to use. They're kind of using a lot of sort of the things that have kind of been cobbled together from larger companies or things that serve larger businesses and get pushed down. They often have to overpay for this stuff. Listen, I mean, it's hard if your only distribution channel is an agent, and the agent's going to make 10-12%. Workers' comp commissions are sometimes on the lower end of commercial lines commissions overall, and you've got a couple $1,000 policy. I mean, there's just not a lot there, and so it's practical for the agent to not be able to spend a lot of time with you. That makes sense. I don't blame the agents for that, right? And so how do we make it better for the agent? How do we give tools for the customers themselves to be able to do some self-service on their own and sort of be able to do some things on their own? And if people want to do that, they can do that. And not everybody will, but some people, will want to avail themselves of that. And so I think it's important to be able to see things from the customer's perspective and try your best to deliver things that are going to be meaningful and valuable to them. So I don't know.
So on that topic, I think it's somebody's asking about how did you find the right beta users? Did you start with beta users? I know.
No, we didn't start with beta users. We just started selling. Yeah, I mean, we were 10 months from founding to starting to sell, and we had to cobble a lot of things together in order to hit that goal. And we had done some early marketing before we were actually able to sell and so we had built up a small amount of customers that we could reach out to. And I tell this story sometimes. So our very first customer, this is actually a great example of sort of one of the things that's broken in the insurance industry. Our very first customer, who is still a customer, by the way, was a small flatware concrete contractor. That's somebody who lays driveways or sidewalks, flooring, and so forth. He was shopping because he had gotten a non-renewal notice from his insurance company because his policy premium was less than $10,000. So there are many companies. There are 345 companies that sell workers' compensation insurance. It's a quite fragmented market. The top 10 only control about 39%, so it's not nearly as concentrated as auto insurance or things like that. There are many companies that either won't write small business at all or have thresholds. We won't write a policy below 5,000 or 10,000 in this case, or we don't do schedule rating below certain amounts and things of that nature. And so this customer was basically getting thrown off of his policy and shopped for pie and bought a policy, right? And so the early customers that we wrote were all direct because we didn't have any agency relationships to stand up at the very beginning. We added agency distribution in the summer of 2018. And then, from that standpoint, it was just sell as many customers as we could, right? Expand the distribution. The notion of beta customers, I think, are important when you're doing a technology project and you're trying to sort of figure things out. In InsurTech, if you don't have a base of data on which to build your pricing algorithms, like we did have and many companies don't, then you have to write some customers with your best guesses of how to do the pricing, and then you have to adapt and adjust to that. We were fortunate in that we had a massive set of data on which to build our pricing algorithms that had been proven and tested over time. So in that sense, we weren't starting from the start line. We were more sort of starting from the midway line in the marathon, which is proven out in our underwriting results that have been very, very strong.
Did you know going into Pie Insurance that you will end up working or creating an agency channel as distributors?
Yeah, from the very beginning.
You didn't,
We knew it because all of the market is in independent agent distribution, right? So it's one of the key things that I learned at Esurance, and that is a lesson that sort of carried me through here, is one of the biggest evils in building an insurance business is lack of scale. You have, because it's a relatively complex technical infrastructure that you have to build, and you can either sell one customer or hopefully a million customers through that technology. And but you largely have to build most of the pieces, whether whatever size or whatever you're going to be, and that takes time, that takes money. So you have to get to scale in order to actually achieve what we all say we're going to deliver, which is more efficient cost structures than the incumbents. And so in order for us to get to that scale, we have to play in the part of the distribution market that where all the business is already. And so, as I said at the beginning, we think independent agents actually are an appropriate and meaningful distribution channel in commercial lines. And so we'll continue to support them forever.
Well, you're certainly not the only one. Why? Oh, well, somebody's asking, why are commissions for agents lower for work comp?
Because the premiums are bigger. It's just the market, right? And so you got BOP commissions that are often in the 20s, GL commissions that are very high. Work comp commissions can be 8, 10, 12%.
So this is a question about talent. A founder of an insurance startup valued at over $1 billion said that attracting talent is challenging. Do you feel that finding good engineers and product people for insurance startup is challenging?
So I think attracting the best talent is always challenging. I think it's one of the most important things that we as founders and as businesses have to achieve. And the right talent can be hugely differentiating, especially, I don't think anybody will disagree with this, in the engineering part of the organization. Finding people so you need to build your organization that has some insurance expertise, some non-insurance expertise. You need to make sure that you are not just rebuilding the same insurance company that already exists, but in the cloud instead of, not in the cloud. You need to actually be thinking about how to do things fundamentally differently, and constantly looking to build the talent of the team. The one thing that I would say that we did, which I'm very glad we did, is we focused on the people side very early at Pi. So interviewing, looking at resume, and I'm talking early days, that can chew up mountains of time for founders and early employees. And a lot of times people are hesitant to add a formal, experienced, high-end talent function until they sort of reach a certain size. I made a bet and added that earlier than most, and it paid huge dividends. And I think that's a leap of faith. You have to sort of be ready to do that early on if you believe you're going to get there. And so we made that bet, and it paid off. It paid off for us.
So describe a little bit the makeup of your team. How many units on claim side, service side? Where is there a focus? Because I think with insurance we tend to do a lot of things, right? We always talk about distribution, but then claims is just as important. We may not talk about it. Then underwriting and pricing and actuaries and of course now engineers. So what's Pi like?
Yeah, so we have about 165 pioneers. We have always been spread across 2 offices. That actually made it easier for us to go work from home immediately and sort of have things structured that way, because we've always worked via video and sort of having some part of, usually there's some part of some meeting or group that is in a different place. We have about 125 in Denver. The reason that's a bigger office is that's where our product and engineering groups are, and that's our biggest part of the company. Our production roles are there as well, which would be sales, customer care, and underwriting. So between those 5 groups, that's most of the 125 people in Denver. On the executive team, we have a balance of 50% of people have insurance experience, and 50% of people do not have prior insurance experience before coming to Pi. That wasn't intentional from a quota standpoint. I wasn't like, okay, now we for this, but if there was intentionality around, making sure that we had a balance on that. We get a lot of questions, are we an insurance company or are we a technology company? And that's where we sort of like the term insurtech, because you have to be both. I'm a strong believer that we have to be able to do the insurance side of this business very well. If we don't do the insurance side of the business better than the incumbents, frankly, we don't really have a chance to take advantage of the technology that we're deploying. And so you have to do both really well, and it's a balance. And you're constantly balancing the team as well. It's frankly, the whole thing's a balancing act, right? In insurance, one of your questions that people might give you is, how do you balance growth with profitability? Because in insurance, there's the old saying, anybody can sell a dollar for 75 cents, right? And so you have to be balanced and measured on your underwriting results and making sure that but you also need to grow. And so it is not easy, right? The folks on this call that are listening, they're trying to do it themselves. We're struggling with it every single day, as I'm sure many people are. And it's sometimes in every balancing act, you're always going to overcompensate one way or another at some point. Rarely are you going to be in that very perfect middle where you're expertly balancing both ends. And so you've got to be able to sort of shift back and forth and course correct when you realize that you've shifted a little bit too much one side versus the other.
I mean, it's kind of like cake, right? You need all ingredients if you want it to taste well, or pie for that matter.
Yeah, we prefer to eat pie for dessert. But.
Do you find that direct acquisition costs are more or less than agency channel?
This is a great question. Obviously, upfront, the direct acquisition costs are more expensive than agency, right? I mean, it's just you're investing in acquiring. If you could acquire a direct customer for less than you could pay for a first-term commission, you should do that all day long, right? That may exist in small segments, but you can't scale a direct acquisition model that way. And so what you hope is that your direct acquisition costs with retention and building in customer lifetime value and potentially adding on other products, if that's something that you have, will then come down, and everybody thinks that direct is going to be cheaper than agency. I will tell you in my experience, and this is primarily from Esurance, that every time you have wins in direct acquisition and you say, oh, wow, we should do more of that, and you do more of that, and you then expand and you need to grow even more, you invariably add on more expensive marginal channels, which drive up your average cost. And so in reality, at a scaled environment, I personally believe they will be largely equivalent. And so that's one of the reasons we are semi-agnostic about distribution channel, is that we have a certain amount allocated, and we don't charge different prices in our different channels. That's another key element, right? So at a certain point, you have X amount of your premium dollar that you allocate towards customer acquisition, and I believe at scale they're going to largely be equal. That doesn't mean they're exactly equal, but they'll be largely equal across the channels.
Do you feel that now that more and more insurtechs are approaching the agency channel, there's still an opportunity for new startups to work with them and create a partnership?
Absolutely, yeah. We see tremendous reception in the agency channel, right? I mean, but agents. I'm not saying this is universal, right? We certainly have agents that say, I'm not going to work with you because you sell directly to customers. We have agents that we approach that say that, and we say, okay, great, then we won't work together, and that's fine. So we're not going to work with 100% of agents. More so, though, what we hear is, thank God, I really need a company like you. because they feel the same things that we see in terms of the industry is not responsive. It does not have broad underwriting coverage. It does not have great prices. And so they're trying to deliver value to their customers, and they're struggling to do it every day. And so we see strong reception from agents working with companies like ours that are delivering value to them and then ultimately value to their customers as well. So I think there is absolutely. I think in commercial lines in particular, if people haven't already started working with agents and they're sort of going strictly, the direct route themselves, I would expect that will continue to evolve, where more people will recognize that they're going to have to work with agents, and they should, frankly, work with agents.
It feels like they are. It's really hard to find somebody that's online only, for sure, in the small business space, even if it's GL, right? We've seen with Next and obviously Hiscox. I've got a universal question, and I'll bring it home because there are a few more questions on COVID. So if you had to expand to a market outside US, which country would you select?
That's a great question.
Would you? Let's start with would you? Would you expand outside of the US? We always say that insurance has borders, and obviously we've seen.
I think property and casualty insurance, US-based companies that get their start in the US, it is challenging to expand outside the US. That doesn't mean it can't be done. Lemonade has done it, and I think there are lines of business where that's more appropriate than others. What's interesting is our particular line of business is not very international because of the way our healthcare system works versus most of the rest of the world. You have different sort of structures for it. That being said, I never say never to anything, and I think down the road that's certainly a possibility, but not on any sort of near-term roadmap for us.
Near term, are you contemplating going beyond work comp?
That is nearer term, but still, pretty far out there. I mean, workers' compensation, COVID, unemployment, all of that impact, pre-COVID, small business workers' compensation was a $25 billion premium annually, and we have a lot of room to grow in that market. I do think we will sell other lines of insurance, both as a manufacturer, where we underwrite and price them ourselves, as well as we'll partner with other companies. In fact, we're partnering with other companies today to offer other products to our direct customers. So, yeah,
I think Progressive is one. Is that a good example?
Yeah, Progressive has a phenomenal commercial auto product, and they offer other lines of insurance. We work differently with folks digitally in terms of online referrals off our website, and then we have some other folks that are available through our sales agents.
Okay, so questions about COVID.
Okay.
Can't wait to get past this, you guys. Any idea about the real estate market sentiments after COVID-19? I live in the city. You take this one.
I'm going to be in commercial real estate today. Let's say that. I don't. That's my own personal opinion. I don't have any sort of business professional knowledge. No.
Yeah. Okay. What are opportunities for an insurance agency in COVID? I definitely heard you talk about the engagement and agents being proactive, trying to help with prices, but, just picking up the phone and say, hey, we're here if you have any questions. Anything else that stands out?
I think this is a window where insurance agents can really prove their value to their customers, right? So, I believe very strongly in if you are an agent and you have small business customers that are coming up on renewal for various policies and so forth, you absolutely should be shopping every single one of those policies, because if you can reduce the amount that your customers have to pay for their insurance over the next stretch of time, that's delivering real meaningful value to them. So shop every single one of them. That's my advice.
you may have answered parts of this, but I'll ask it anyway, just for the sake of the person that's asking. How did you adapt to the changes in business made during COVID that may have changed their risk profile? And do you think that will create a fundamental change in business operations?
So as I said, we were proactive about finding, helping customers, interim endorse their policies for reduced payrolls and so forth, finding other ways to give them payment leniency and so forth. We are looking at our underwriting guidelines around, businesses that have a predominant amount of their folks that are working from home versus in an office environment. Before COVID, we tended to not like that as much because it's a less controlled environment if you have a lot of work from home employees. But we'll look at that as well. And frankly, there's a lot of articles that come out about, how much is COVID going to cost the insurance industry, and work comp's going to bear a lot of the costs of that. The places where those claims are showing up, I think there could be a lot of workers' compensation expense, in tens of billions potentially or more in the industry, but that's a lot. It's heavily first responders, hospitals, sort of things that we don't write because that's not really small business. We don't write municipalities. We write home health care, but we don't write, healthcare. So I think we're going to see structural changes in the industry broadly. I think we'll see some sort of pandemic response type, federal backstop type thing, which I think would be a good thing. I don't think we can ask the private insurance industry to pay for appropriate yet government imposed shutdowns of the economy. I don't think you can underwrite that with private insurance, or should. And so it'll be interesting to see where all of that shakes out. We are seeing the impact that we see today is actually, frankly, lower claim frequency during this shutdown window because people aren't working. So It's kind of like the auto insurers are seeing lower accident incidents because not as many people are driving. Well, not as many people are working in the same environments where they were before, and so you get lower claim frequency. Now, if we get this recession that drags on for a while, potentially, then you might get some of that natural macroeconomic impact on workers' compensation. But the shock effect right now is just lower claim frequency.
Gotcha. All right. Final question. It's a bold fact that tech hiring in U.S. is quite expensive. Would you consider outsourcing your tech to Asian countries? How do you say pioneer?
What's that?
How do you say pioneer in a different language?
Yeah. So we have not done that previously because we valued having everybody together in our product and tech teams. As we've been working remotely now, we're going to consider that not as a way of replacement, but as a way of augmenting our teams and getting hopefully more for less dollars in those environments. I think that's a natural evolution for businesses, and we're hitting that point as well.
Final thoughts you want to share? You've shared a lot.
Yeah, well, I really appreciate the opportunity. As I've said before, I really appreciate the coverage that you guys give to the, it was a little bit of a pun there, it's a pie like the pie pun. So the coverage that Coverager gives to the industry, I read it every day, and just appreciate the opportunity to share our story with you.
Thank you so much for joining. You're welcome anytime. I always learn something new. Guys, John is fourth generation. If I didn't say that, fourth generation in insurance, obviously from insurance too, which gets to be confusing. The word on the street is you guys are going from growth to growth. We're happy to stay and follow you. We love that. Appreciate the interaction. And thanks everybody for joining us. So John Swigart, CEO and co-founder of Pie Insurance. Best for now.
Great.
Bye,
Thanks
everybody.
Thanks, Jeffy. Bye-bye.